So you're not seeing a real slowdown because of COVID-19.
No, the purchases did pause temporarily, of course, with the quarantine business. But it is a very good time to be purchasing a home because of the buying power with the low interest rates. Take rates a year ago, if someone was in the mid fours and now we're in the low threes in a conventional loan, your buying power is 25% greater in what you're saving in principal and interest alone. So it is a significant difference, and it has been a little bit tough to encourage some of those first-time home buyers, but we're seeing a lot of millennials right now realize that during the COVID-19 and during the quarantine, that they were not really living in an apartment wasn't ideal. They realize that how important it is to have their own home and set up so they can work from home.
Oh, well, that's interesting. So the changes that you've seen is really what people are looking for. And so how does that work? What do you think is if somebody's thinking about buying a house, let's say, so what do you think the first thing they should do?
The first thing they need to do is get pre-approved. Sitting down with a loan officer and putting together not your short and long-term financial plans to get pre-approved is very important. The reality is in today's market, you can do a lot of stuff online. You can view homes, tour homes with some of these new tools, but getting pre-approved is really important because everybody likes the idea of having a $500,000 or $600,000 home, and then they see what the payment is, and then they're like, "Oh, I like the payment actually on a 300 and 350," and that's what should be done in an effective pre-approval.
Oh, so you actually do a full-on interview process. It's not just like, I see some of those online portals and you can go and put your social security number in and they pull your credit and you put some data in there. But it's not really a full-on interview with a loan officer, say. So when you're interviewing new buyers, or new families to get into a new home, so how long does that process usually take?
I like to take about 30 minutes to an hour with my initial phone conversation. I do like to meet people in the office, but given what we're dealing with right now with COVID, that's not a reality. So most of it's done via phone call, or we could do it Zoom or Google Duo meetings, stuff like that over the phone or from my desktop. But I do like to sit down and talk to people because I've always said getting prepared to finance a home should be like going upstairs. Your first one, you shouldn't be jumping 6 stairs. They need to put their foot in the water. And that's part of making sure that helping them meet their short and long-term goals. $500,000 home with 10% down is going to be, your payment's going to be like $2,500 a month. Most people aren't ready for that. They like the look of the home, but as first-time home buyers, you want to be set up to succeed, not overstep your boundaries, because a lot of these buyers have student loans and other stuff like that. And by the time they pay that off and want to upgrade, maybe they turn that into a rental. And then, so I've always compared buying a home like to going up a set of stairs.
Oh, so maybe you buy your first house and you live in it for a while, and then another baby comes or your family gets bigger, and then you decide that you need to move up to the next house.
Exactly. Because the reality is most people aren't aware of the capital gains exception. If you live in a home for 2 years and you buy it for 300, you live in it for, let's say, 5 years, and you sell it for 450. If you're married, you have up to a $500,000 exemption without paying any taxes on that gain and rolling it over as your down payment into your next home. And that's really big with a lot of the younger or first-time home buyers, because maybe they're putting 3% down or 5% down and not realizing how much tax benefit they have, rolling those proceeds into their next purchase.
So I'm curious, of all of the purchases that you're working on loans for right now, what is the average sales price of those houses?
I would say about 300 to 350.
Okay. So they're starting at, as far as the pre-approval process for somebody, so they come in, they interview with you for about 5 minutes or 30 minutes to an hour. You have a conversation with them, and then you start the process. So you provide them a list of documents. What are some of those documents?
Well, luckily for us today, we've come quite a bit. Even since I was a processor, we needed to go through all of your tax returns and everything. Luckily for about 90% of Americans, all we need is W-2s, pay stubs, verify your employment history, stuff like that, to make sure you have the down payment and the income to support what I've gotten on a loan application. So there's a lot of loans we can get away with just your W-2s, your pay stubs, your bank statements. And, we now, with all the security issues, we do need copies of your driver's license, because, as with everything that's going on, and a lot of people do like to use the digital age, we still need a copy of your driver's license to verify you are who you say you are when I'm talking to you, if you like to do everything online.
Mm-hmm. So then, that leads me to the next question is, you're working with purchasers that are about the 300 to 400 range. I heard there was something going on with jumbo loans. So can you explain to me what a jumbo loan is and what the issue is with jumbo loans?
So a jumbo loan goes by many names. The biggest one you're going to hear is non-conforming. That means, so conforming limit is $510,000 and some change in the United States. That means that it is insured usually by Fannie, Freddie, or HUD, who oversees the USDA, VA, and FHA. And the banks, or the investor, is a little bit protected with an insurance policy on those loans. When you get into jumbo or non-conforming loans, that's anything over that. So maybe it's an $800,000 home that they're putting 20% down. So, their loan amount $640,000. That's usually direct to a large investor like Chase, Wells Fargo. And up till about 2 months ago, there was a lot of outlets that finance those homes. Now we are very limited, and it has almost shut down as of a few weeks ago. Some of them have gotten back into it, Chase, a few other lenders, but they're very difficult to come by. Because what happens is, take Bank of America on a $2.5 million purchase. They're on the hook for the entire amount if something happens on those loans. So if someone, say, loses their jobs, they got to hire an attorney and go through the full legal process, which could cost them $50,000 to $100,000 to take the house back, get it back onto auction or whatever their process is going to be for relisting it. And that's why a jumbo loan, when we have an economic turn down, they tend to get out of the market the first, because there's no insurance on them. Those lenders are on the hook themselves.
That's interesting. So they meaning the government back loans but a jumbo loan is non-conforming. So there's no way to recoup a loss for that for the lender.
Not through an insurance policy, which Fannie, Freddie, and HUD issue with the FHA, USDA, or VA. Mm-hmm. No, the lender is literally portfolioing that loan themselves. And that's why the underwriting and the qualification and everything for those loans are very significant, because it's your full exposure to the lender. There's no insurance policy.
Okay. So, and I'm sorry, what did you say the jumbo limit was right now?
So any loan over $510,000. I think it's $510,000 and some change, like 400 or something like that. The issue is when you get into other counties, like Hood River and Skamania County border the Portland metro area. So we can do like an FHA loan up to like $495. You get into Klickitat and Wasco, you can't do an FHA loan above $335,000, I think is what it is. So it's really important to talk to your lender about that, because every county's limits are different, especially when you need the USDA and qualifying income amounts. The VA has the Blue Water Credit Act that goes up to $1.5 million with zero down. So the VA is pretty well protected. That's probably will be one of the biggest buyers in the jumbo market, or the best loans to see, because the VA is a great loan program for up to $1.5 million with zero down.
Wow. So a VA, somebody who qualifies. How do you qualify for a VA loan?
You have to have a DD-214. That's going to be the biggest thing. That's going to have all of your service record. And then usually within 24 hours, sometimes within a few hours, if they can supply me a copy of their DD-214 through the VA portal, I can get a copy of their COE, which is their certificate of eligibility, that details their eligibility for the VA loan. And then it's qualifying like a regular loan. Income. Yeah. If they're zero down, really all they have to cover is their closing costs, and then just to make sure that they meet the debt to income requirements of the VA.
So I've heard of a term for VA loans called double zero down. Is that an old thing, or is that a thing?
Yep. Yeah. So, before everything that happened in 2008, there was a lot of loan programs out there. There's a lot of myths still going on about the VA, like the seller has to pay $1 bazillion in the VA's closing costs. That's not the case, because a lot of those junk fees that were out there are outlawed now. There's been a lot of things cleaned up in the loan market since 2008. But yeah, no, the VA still does have to pay their closing costs. There's a few programs state by state where the vet can get a program to help cover some of those closing costs. But if you're talking about a $1.5 million home, that's usually your income's so high you don't qualify for those programs.
Oh, right. Okay. So that's about, pre-approvals and jumbos. Here's one for you. What do you see for financing for people who are self-employed?
So that's getting a little more difficult. It varies lender by lender. Luckily for us at CrossCountry, we portfolio and service a lot of our own loans. So we haven't had the large loan level pricing adjustments, or what they're called, or overlays, which is you take Fannie Mae's typical underwriting guidelines and you add your own levels of risk to kind of filter out self-employed borrowers. We haven't seen any of those yet, but some lenders have added those. There's some lenders that I direct to, like Chase is one that has added quite a bit of loan level pricing adjustments for self-employed borrowers because they consider them risky due to the COVID and maybe loss of income during this time. But it can get a little more difficult. This is where picking a loan officer is very important, because you need to have a full income calculation on the sustainability of your income done for qualifying. Because the worst thing that can happen is that loan officer didn't do a full breakdown of your sustainable income. You get into contract and then you find out that there's what we call a haircut. Like they take a lot off your self-employment income due to COVID-19 or a downturn in the economy, and then you don't qualify anymore. And then maybe you're out the cost of your inspection and your appraisal when that could have been caught up, or should have been caught up front.
Oh, so the pre-approval process, back to the pre-approval process, really, I think what you're saying is if the loan officer has done